All right, welcome back to The Explainer. So today we're doing something a little different. I want you to step into a brand new role. Imagine you've literally just been hired as a sell-side equity analyst. Congratulations! Your very first assignment? Pinpoint the true intrinsic value of the aerospace and defense giant Curtiss-Wright. But here's the catch. You're locked in a room with absolutely nothing but a high-level metrics dashboard. Seriously, no 100-page 10K reports, no management team on speed dial, just you and the data. We have to build a rigorous professional valuation based strictly on the numbers we actually have in front of us. Let's get into it.
Okay, here's our game plan for today. The Analyst Challenge, Absolute Valuation, exploring some of the parts, relative valuation, asset-based strategies, and finally, the final verdict.
Part 1. The Sell-Side Analyst Challenge.
So as an analyst, your primary job is basically to decipher the market's current guess and then compare that against the actual mathematical intrinsic value. Right now, our starting line is $724.43. That's Curtiss-Wright's last closing stock price, which gives them a massive $26.7 billion market cap. But remember, as fundamental analysts, that's just the price tag. It's not necessarily the true value. And you'll see why that distinction matters right away, because when we run the data from our constrained dashboard, we get a completely fascinating discrepancy. The model is spitting out two entirely different fair value outputs. One suggests the intrinsic value is actually an impressive $932, but the other? It implies it's only worth $631. So is this stock significantly undervalued, or are we looking at something dangerously overvalued? That right there is the central mystery we have to solve today.
Part 2. Absolute Valuation, Fair Value. We really want to find the firm's true fair value based strictly on its raw fundamentals. Now, in a perfect world, a comprehensive analysis might include something like a residual income or maybe an adjusted present value model. But our dashboard constraints limit what we can actually do here. Therefore, our absolute gold standard today is the discounted cash flow model, the DCF. We're deriving value directly from the company's expected, unlevered free cash flows, and then we're discounting those right back to today's present value.
And wow, when you actually look at Curtiss-Wright's cash flow profile, it is incredibly robust. Just look at these growth rates for a second. The free cash flow compound annual growth rate over the last 3 years is sitting at a whopping 29.2%. And over the last 5 years, it's almost 21%. Now sure, that's alongside a fairly modest free cash flow yield of 2.07%, but this historical growth trajectory provides an incredibly strong, solid foundation for the assumptions feeding into our DCF model.
And those massive compounding cash flows are exactly what drives that first fair value output we saw earlier, $932.69. That is our DCF fair value, completely derived from free cash flow. When you compare that to the current price of $724, it gives us a really attractive 22.33% margin of safety. Basically, if you strictly follow the cash here, the model is absolutely screaming buy.
But wait a second, what about a dividend discount model or DDM? Can we just value the stock based on the actual cash being returned to the shareholders? Well, checking the company's dividend profile, they do have 9 consecutive years of increases, which, is definitely nice. And they've got a 14.33% trailing growth rate. But here's the rub. The yield is a microscopic 0.13%, and the payout ratio is only 7.4%.
So as a professional analyst, you kind of have to take the DDM and just throw it right out the window for this specific scenario. With a yield of just 0.13%, a dividend discount model completely fails to capture Curtiss-Wright's true equity value. Think about it. The payout ratio is sitting in the single digits, meaning the company is retaining over 90% of its earnings to reinvest in the business or pay down debt. Because of that, a multi-stage DDM would drastically undervalue the firm compared to our DCF. So we have to explicitly state that limitation and totally discard the DDM approach here.
Section 3. Exploring Sum of the Parts.
Now, a lot of the time, industrial and defense conglomerates have these really distinct business units that frankly deserve totally different multiples. Theoretically, a sum of the parts model, or SOTP, should isolate these individual segments, value each one completely independently based on its own unique risk profile, and then sum all those equity values up, making sure to adjust for corporate debt at the end. But here is exactly where we hit a brick wall. And honestly, it's a fantastic teaching moment for any analyst. To do this right, the ideal data requires a super detailed segment breakdown. However, our provided source document, our dashboard, only gives us aggregate metrics and consolidated financials. Without those specific, granular segment data points, an SOTP simply cannot be reliably performed. And as analysts, we cannot just hallucinate data. We can't make it up. So we note the theoretical applicability, we declare the limitation clearly, and we skip this model.
You always have to adapt to your data constraints.
Part 4. Relative Valuation. Market Multiples.
Okay, since we can't break the company apart, let's look at how the consolidated entity is currently being priced relative to the broader market. Let's take a look at the price-to-earnings ratios. The current PE is sitting at a really sky-high 56.29. That is a massive 48.83% premium over its 3-year average. However, the forward PE estimate drops significantly, all the way down to 28.41. That tells us the market is clearly expecting a massive surge in future earnings. But right now, today, you're paying top dollar for trailing earnings.
And it's not just an earnings anomaly either. Look at the other multiples here. Enterprise value to EBITDA is currently 35.55. That's way above the 26.31 historical average. The price-to-book ratio is over 10. Even the PEG ratio, which actually factors in growth, is sitting at 2.56. That indicates the stock is expensive even when you adjust for that expected growth. So across the board, our relative valuation models are showing that the market has absolutely priced in a hefty premium.
Section 5. Asset-based strategies. So could we value this company by calculating its net asset value, or maybe by assessing some sort of expanded liquidation value? Well, once again, our role requires total discipline. The total EV to assets ratio is 5.19, sure, but we totally lack granular balance sheet line items on our dashboard. Without knowing exactly what those assets actually are, and without specific liabilities to subtract from them, creating an accurate NAV or liquidation model would, again, require heavy hallucination of data. To maintain our analytical integrity, we must declare this data missing and bypass the asset-based approach entirely.
Part 6. The final verdict.
All right, we have pushed our constrained data to the absolute limit, and the crucial takeaway here is this incredibly stark contrast. Our bull case is entirely driven by the absolute valuation of that free cash flow, giving us a $932 fair value and a really nice positive 22% margin of safety. But on the flip side, the bear case, which is driven by earnings per share and those highly inflated relative market multiples, values the stock at only $631. That represents a negative 14% margin of safety.
So the dashboard paints a picture of a company generating absolutely incredible cash, but it's trading at historically stretched earnings multiples. As the analyst, the final decision ultimately rests entirely with you. When the accounting metrics diverge this sharply, what do you actually hang your hat on? Do you trust the raw, unlevered cash flow, or do you trust the earnings and the market's current premium? Think about it. See you in the next explainer.